Today we're diving deep into a popular emerging markets choice, the iShares Core MSCI Emerging Markets ETF, ticker symbol IEMG. Emerging markets offer explosive growth potential, but also some serious risks. Before you jump in, let's crack open IEMG and see what's inside. We'll talk expense ratios, hidden risks, and how IEMG stacks up against the competition. Plus, is picking individual emerging market stocks a better option? Buckle up, because we're about to explore the wild world of emerging markets with IEMG. What is IEMG ETF? IEMG, ticker symbol for the iShares Core MSCI Emerging Markets ETF, is an exchange-traded fund, ETF, designed to track the performance of a broad basket of stocks in emerging market countries. Here's a breakdown of what that means. Exchange-traded fund, ETF. An ETF is a security that trades on a stock exchange, like a regular stock. However, unlike a single company's stock, an ETF holds a collection of underlying investments, often a basket of stocks that track a particular index. In the case of IEMG, the ETF tracks an index of emerging market stocks. Emerging markets. Emerging markets are countries that are in the process of transitioning from developing economies to developed economies. These countries often have characteristics like rapid economic growth, increasing industrialization, developing capital markets. iShares Core MSCI Emerging Markets Index, IEMG specifically tracks the MSCI Emerging Markets Index, EM, an index created by MSCI Incorporated, a leading provider of investment research and tools. The EM index includes stocks from a broad range of emerging market countries, representing various sectors and company sizes, large, mid, and small capitalization. Investment objective of IEMG. The primary goal of IEMG is to provide investors with exposure to the overall performance of the emerging market stock market through a single investment. This allows investors to potentially benefit from the growth potential of these economies without having to pick individual stocks. Key features of IEMG. Diversification. By holding a basket of stocks across various emerging market countries and sectors, IEMG offers diversification, which can help reduce portfolio risk. Low cost. IEMG is known for its low expense ratio, which is the annual fee charged by the fund to manage its holdings. This makes it a cost-effective way to gain exposure to emerging markets. Passive management. IEMG is a passively managed ETF. This means the fund simply tracks the underlying index and doesn't attempt to outperform it through active stock selection. What is IEMG's underlying index and its methodology? IEMG tracks the MSCI Emerging Markets Index, EM, but understanding how this index is constructed and what it represents is essential for evaluating IEMG's investment strategy. Here's a deeper dive into IEMG's underlying index and its methodology. The index, MSCI Emerging Markets Index, EM. MSCI, or Morgan Stanley Capital International, is a renowned provider of investment research and tools. One of their core products is a family of stock market indexes, including the MSCI Emerging Markets Index, EM. This specific index serves as the benchmark that IEMG aims to replicate. Methodology for index construction. The MSCI EM index construction follows a specific set of rules to ensure a diversified and investable representation of the emerging market universe. Here are some key aspects of the methodology. Market capitalization. The index is primarily market cap weighted. This means companies with a larger market capitalization, total stock market value, have a greater weighting within the index compared to smaller companies. This reflects the influence of larger companies on the overall emerging market performance. Free float adjusted market capitalization. The index uses free float market capitalization, which considers only the portion of a company's shares readily available for trading in the public markets. This excludes restricted shares held by major shareholders or governments. Liquidity. The index constituents are chosen based on their liquidity, meaning they must be easily tradable in the stock market. This ensures the index itself reflects an investable universe. Industry classification. The index categorizes companies into various industry sectors, e.g., financials, technology, consumer staples. This helps maintain a diversified sector allocation within the index. Country classification. The index includes companies from a diversified set of emerging market countries. MSCI has its own classification system to define emerging markets, and this classification can evolve over time. Capping. To prevent any single company or country from dominating the index, MSCI might impose capping methodologies. This limits the maximum weight any individual company or country can have within the index. Rebalancing. The MSCI EM index is rebalanced periodically, typically quarterly. During a rebalancing, the index composition is adjusted to reflect changes in the underlying company's market capitalizations, liquidity, or adherence to the inclusion criteria. This ensures the index continues to represent the current state of the emerging market universe. Impact on IEMG. By tracking the MSCI EM index, IEMG inherits the characteristics and methodology outlined above. This means IEMG's portfolio will mirror the composition and weighting of the index, offering exposure to a broad basket of emerging market stocks across various countries and sectors. How does IEMG's expense ratio compare to similar emerging markets ETFs? IEMG is known for its low expense ratio, but comparing it to similar emerging markets ETFs provides valuable context for cost-conscious investors. Here's a breakdown of how IEMG's expense ratio stacks up. Understanding expense ratios. An expense ratio is an annual fee charged by a fund to cover its operational costs, including management fees, administrative expenses, and marketing costs. A lower expense ratio translates to a higher percentage of the fund's returns being captured by investors. IEMG's expense ratio. IEMG boasts a very competitive expense ratio. As of April 30, 2024, the expense ratio for IEMG is around 0.09%, reference source about IEMG expense ratio. This is a very low fee, making IEMG an attractive option for investors seeking cost-effective exposure to emerging markets. Comparison with similar ETFs. Here's a comparison of expense ratios for some popular emerging markets ETFs. Vanguard FTSE Emerging Markets ETF, VWO, expense ratio around 0.11%. SPDR SP Emerging Markets ETF, EMB, expense ratio around 0.6%. Schwab Emerging Markets Equity ETF, SCHE, expense ratio around 0.1%. Key takeaways. IEMG has a clear advantage in terms of expense ratio, compared to EMB, a more actively managed fund. VWO and SCHE offer expense ratios comparable to IEMG, with slight variations. Even a seemingly small difference in expense ratio can significantly impact returns over time, especially for long-term investors. For example, a 0.02% difference in expense ratio might result in a noticeable performance gap over a decade. How liquid is IEMG compared to other emerging markets ETFs? Liquidity refers to the ease with which an investment can be bought and sold in the market. Here's a detailed analysis of IEMG's liquidity compared to other emerging markets ETFs. IEMG's liquidity. IEMG is generally considered a highly liquid ETF. Here's why. High trading volume. IEMG boasts a very high daily trading volume, meaning a significant number of shares are bought and sold each day. This high volume translates to easier entry and exit points for investors. Underlying holdings. IEMG tracks the MSCI Emerging Markets Index, EM, which itself is composed of large and mid-capitalization stocks from emerging markets. These larger companies tend to have higher trading volumes and better liquidity compared to smaller companies. ETF structure. By its nature, an ETF trades like a stock on a stock exchange. This allows for quick and efficient buying and selling throughout the trading day. Comparison with other emerging markets ETFs. Here's how IEMG's liquidity stacks up against some competitors. Vanguard FTSE Emerging Markets ETF, VWO. VWO is another large and popular emerging markets ETF with very high trading volume, making it comparable to IEMG in terms of liquidity. SPDR SP Emerging Markets ETF, EMB. EMB might have slightly lower trading volume compared to IEMG and VWO. This could potentially lead to wider bid-ask spreads, the difference between the price a buyer is willing to pay and the price a seller is willing to accept, for EMB. Schwab Emerging Markets Equity ETF, SCHE. SCHE is another large emerging markets ETF with good liquidity, likely comparable to IEMG and VWO. Factors affecting liquidity. While IEMG generally offers good liquidity, certain factors can impact it. Market conditions. During periods of high market volatility or overall lower trading activity, even a typically liquid ETF like IEMG might experience wider bid-ask spreads or slightly lower trading volume. Order size. If an investor wants to buy or sell a very large block of IEMG shares, they might encounter some difficulty due to the sheer size of the order. In such cases, it might be necessary to break the order into smaller chunks to ensure efficient execution. Implications for investors. High liquidity is important for investors who want to easily enter and exit their positions without significant impacts on price. IEMG's strong liquidity allows investors to make adjustments to their portfolio allocation involving IEMG with relative ease. However, it's still wise to be mindful of market conditions and potential bid-ask spreads, especially when placing large orders. What are the primary risks associated with investing in emerging markets through IEMG? IEMG offers exposure to emerging markets, which carry inherent risks compared to developed markets. Here's a breakdown of the key risks involved in investing in emerging markets through IEMG. Economic and political risk. Emerging economies are generally more volatile. They might experience periods of rapid growth followed by sudden downturns. This volatility can translate into significant fluctuations in IEMG's price. Political instability. Emerging markets can be susceptible to political unrest, corruption, or changes in government policies. These factors can disrupt economic activity and negatively impact company performance, ultimately affecting IEMG's returns. Currency fluctuations. The value of emerging market currencies can be volatile compared to more established currencies. This currency risk can erode the value of IEMG's holdings when converted back to the investor's home currency. Market risk. Emerging markets are generally less liquid than developed markets. This means it might be more difficult to buy or sell IEMG shares quickly, especially during periods of market stress. Lower regulatory standards and corporate governance. Emerging markets might have less stringent regulations and corporate governance practices compared to developed markets. This can increase the risk of fraud, accounting irregularities, or mismanagement within companies held by IEMG. Concentration risk. While IEMG offers diversification across multiple emerging markets, it might still be more concentrated compared to a globally diversified ETF. This means the performance of IEMG could be more heavily influenced by the performance of a particular country or sector within the emerging markets. Other considerations. Limited access to information. It can be more challenging to obtain reliable and timely information about companies in emerging markets compared to developed markets. This can make it difficult for investors to fully assess the risks and potential rewards of individual holdings within IEMG. Taxation. Depending on the investor's location and tax situation, investing in emerging markets through IEMG might involve additional tax considerations compared to domestic investments. How frequently does the underlying index composition of IEMG change? The underlying index composition of IEMG, the MSCI Emerging Markets Index, EM, is subject to periodic adjustments. Here's a breakdown of the frequency and rationale behind these changes. Rebalancing schedule. The MSCI EM index is typically rebalanced quarterly. This means the index constituents and their weightings within the index are reviewed and potentially adjusted on a quarterly basis. Reasons for rebalancing. There are two primary reasons why the index composition might change. Market capitalization. The primary driver for rebalancing is changes in the market capitalization of the underlying companies. As companies' stock prices fluctuate, their relative weightings within the index can deviate from the target weightings. Rebalancing ensures the index continues to reflect the current market realities of the emerging market universe. For example, if a company within IEMG experiences significant stock price growth, its weighting within the index might become too high. Rebalancing would involve selling some shares of this company to bring its weighting back in line with the target allocation. Index methodology. The MSCI might occasionally modify its index methodology, including eligibility criteria for inclusion or exclusion of certain companies. These changes can also necessitate adjustments to the index composition during the rebalancing process. Impact on IEMG. Since IEMG passively tracks the MSCI EM index, any changes in the index composition are directly reflected in IEMG's holdings. This means the specific companies and their weightings within IEMG will also adjust during rebalancing periods. Are there any actively managed emerging markets mutual funds instead of an ETF? There are definitely actively managed emerging markets mutual funds available as an alternative to IEMG, which is a passively managed ETF. Here's a breakdown of the key differences and factors to consider when choosing between the two. Actively managed emerging markets mutual funds. These funds are overseen by professional portfolio managers who actively research and select individual stocks within the emerging markets. The goal is to outperform a benchmark index, such as the MSCI EM index, that IEMG tracks. Potential advantages of actively managed funds. Outperformance potential. Skilled portfolio managers might be able to identify undervalued companies or exploit market inefficiencies, leading to potentially higher returns compared to a passively managed ETF. Flexibility. Active managers have more flexibility in their investment choices. They can invest in smaller companies or companies not yet included in the benchmark index, potentially offering exposure to high-growth opportunities. Tailored strategies. Some actively managed funds might focus on specific emerging market regions or sectors that align with your investment goals. Potential disadvantages of actively managed funds. Higher fees. Actively managed funds typically have higher expense ratios compared to passively managed ETFs, like IEMG. These fees can eat into potential returns over time. Performance risk. There's no guarantee that active managers will outperform the market. Many actively managed funds underperform their benchmark indexes. Manager dependence. The performance of an actively managed fund relies heavily on the skills and investment decisions of the portfolio manager. There's always the risk that the manager underperforms. Choosing between IEMG and actively managed funds. Here are some factors to consider when deciding between IEMG and actively managed emerging markets mutual funds. Investment goals. Are you prioritizing low cost and broad market exposure, IEMG, or are you willing to pay higher fees for the potential of outperformance, actively managed fund? Risk tolerance. Actively managed funds can be more volatile than IEMG. Consider your risk tolerance before choosing an actively managed fund. Investment time horizon. Actively managed funds might be a better option for a longer investment horizon where potential outperformance can outweigh higher fees. Manager track record. If considering an actively managed fund, research the fund's past performance and the track record of the portfolio manager. Would an investment in individual emerging market stocks provide a better risk-reward profile for your goals? Whether investing in individual emerging market stocks offers a better risk-reward profile for your goals depends on several factors. Here's a breakdown of the pros and cons to help you decide. Potential advantages of individual stock picking. Higher potential returns. By carefully selecting undervalued or high-growth companies, you might achieve returns exceeding those of a broad emerging markets ETF like IEMG. Tailored exposure. You can build a portfolio that aligns perfectly with your investment thesis and risk tolerance by choosing specific companies within emerging markets. Direct company control. You have more control over your investment decisions and the companies you choose to support. Significant disadvantages of individual stock picking. Higher risk. Emerging markets are inherently more volatile than developed markets. Picking individual stocks adds another layer of risk, as company-specific factors can significantly impact performance. Extensive research required. Properly evaluating individual companies in emerging markets requires in-depth research and analysis of the company, the industry, and the overall economic and political landscape of the country. This can be very time-consuming. Large time commitment. Actively managing a portfolio of individual stocks requires constant monitoring, news tracking, and potentially frequent adjustments. This can be a significant time commitment. Diversification challenges. Building a truly diversified portfolio with individual stocks is challenging, especially with the limited number of companies most investors can realistically research and follow. Alright, Chat ETF fam, that's all the time we have for IEMG today. Remember, emerging markets can be a thrilling ride, but with some bumps along the way. So, is IEMG the right choice for you? It depends. We explored actively managed funds and individual stock picking as alternatives, but the best option aligns with your unique investment strategy. Head down to the comments and let us know what you think about IEMG. Have you considered emerging markets? What are your biggest concerns? And don't forget to like and subscribe for more in-depth ETF explorations.